Good evening and a very warm welcome to all our viewers to the 43rd edition of Cedrus Knowledge Series. We started this knowledge series amidst the lockdown with an objective of having one speaker each month, speaking not just on finance and investments, but overall well being and personal health. We'll now play a short video of Cedrus Wealth Partners. Today, in our 43rd edition, we are extremely pleased to have with us Mr. Abhishek Bisen. He's the debt fund manager at Kotak Mutual Fund. And with the rich experience of over 2 decades, Mr. Bisen will be throwing light on how the falling interest rates will impact the overall debt market. We'll now play a short video to further introduce Mr. Abhishek. A very warm welcome, sir, and it's an absolute honor to have you with us today. And we all are, in fact, eager to hear your views on, what will be the impact of the falling interest rates. For all our investors, this is a moderated session where we will be asking our set of questions to Mr. Bisen. And if you all have any questions, you all can post them in the comment section. We will be happy to take them towards the end of the discussion. And I would now like to hand it over to Mr. Nilesh Bajaj for taking the discussion forward.
Thank you, Unnati, for the wonderful introduction as always. Thank you, Abhishek, and welcome to all our viewers. Abhishek is there because I think there is so much of discussion happening around equity markets, and I think somewhere debt markets have been ignored.
Correct.
And when we talk to investors, when we talk to people from your industry also, they all are gung-ho about equities. And somewhere I think debt plays a very important role. And as a wealth advisor, I think, it is very important that when there are opportunities, we need to see that we advise investors in a more relevant way. And Abhishek, I think, what has happened is since March 2023, when the indexation was taken away, I think the interest in long-term debt has waned to only opportunistic investments, in the
Correct.
sense that there are falling yield scenarios or there are some opportunities in the credit space. Beyond that, I think, what used to be earlier, the tax efficiency angle, I think that no more exists. And I think one opportunity which we can see right now, and that's what we felt that, this will be a very relevant topic for this month's knowledge series, is that how, in case if yields fall, and there are some indications where we see that yields may fall. They have already corrected a bit from 7.4 to sub 7% now, and we expect them to fall more. how will they impact the investors who have invested in the debt market, and which space they should be in fact. So taking this, forward, Abhishek, my first question to you is, and it's a more broader question, is what is the opportunity you see for an investor who's not got any kind of a motivation to invest now for indexation benefit, okay, but for someone who can get a better return with safety in the debt, in the long term debt markets? What is the opportunity you're seeing today?
Yeah. Firstly, thank you, Nilesh Bhai, for inviting me over this knowledge series. And thank you, Nadi, for a fantastic introduction. I am overwhelmed. So, coming to your question, Nilesh Bhai, instead of opportunity, let's understand what is the threat as far as the interest rate environment is concerned. So, for fixed income investment, the biggest threat or biggest risk you have is a the credit risk. So we have just kept it aside for the time being. But moreover, you have a reinvestment risk, which is even bigger at times, and in especially such times when which we are currently right now. There are fundamental shifts happening. So what events are happening we have not seen in the past, and we've not even discussed in the past, like what is happening over the period of time. Yesterday we got included in the JP Morgan index. It was spoken for a very long period of time, and eventually it is done. And if you look at from a sovereign rating as well, the outlook has been changed to positive, and we are thinking about a rating upgrade. So these kind of changes are we call fundamental changes. And if you look at a fiscal profile, the government is extremely sensitive about the fiscal profile, what kind of expenditures to be done, and the fiscal balance to be maintained, and eventually overall it will reflect in the rating of the country. So what this means effectively that your long term structural yields are going to keep decelerating slowly, or it can fasten also, because the way events unfold. Suddenly tomorrow you get a large flow, it can happen very fast. It becomes slightly slower, some event happens, some outflow happens, it can go slightly up, but then again go start falling. But the larger picture is that long term interest rates structurally are going to move gradually downwards, and effectively, let's say a 3 or a 5 year, which we speak a medium term outlook on interest rate. We think about what where we would be 3 year down the line, or where would be 5 year down the line. These long term interest rates would be a dream at that point in time. Like for example, when we transited towards debt market development, when we started working at that point in time, the 10 year was in double digits, and it was said that these are gold mines. You just buy it because you are not going to get it. So that from that journey, you see gradually started decelerating, but it plateaued at 7 to 8% or 8% handle for a very long period of time. And the long term interest rates used to be steeper. What I'm saying is, the 10 year, let's say, is at 7%, the 30 year used to be 7.5, and so on and so forth. But now it has become completely flat. And that is because of the investment demand from our own investors and offshore investors as well. So what they're showing a larger commitment, and you can see the vision they have, or we may call a threat, which they believe that reinvestment, when you come out of that 10 year bond or a 5 year bond, when it matures, the reinvestment risk is even bigger, which is what is getting reflected into current prices today. So once you decided that this is your asset allocation, today is a time when you need to sow seeds for a longer period of time, and therefore you need to be in the longest bucket as far as your fixed income allocation is concerned.
Mhm. No, so wonderful. I think the reinvestment risk is something which a fund manager, a debt fund manager, can completely negate, actually, because he can actually be at any end of the curve, at the higher
Yeah,
end or the low end of the curve, based
absolutely,
on the
absolutely,
interest rate scenario.
absolutely.
In fact,
Yes,
and that is where we can have a strategy which is a more of a long term all weather strategy, where you don't have to think about moving in
sure.
and out of debt funds, in fact. But talking about today, actually, you just mentioned the JP Morgan, our inclusion in the JP Morgan bond index. It just happened yesterday.
Yeah,
It was going on since a while, and finally we are there.
correct.
We are included in the index. And second thing is an expectation of expected rate cuts. There's an expectation that maybe yields may fall, okay, in the future. It's already started. So, what is this inclusion in the bond index? How will it impact? Like structurally is one part of it, but why are people talking about if it because it's got included in the index for our investors, for the benefit of our investors? How will it impact the yields in India?
Yeah, so let me explain it in absolutely granular and simpler terms. So this JP Morgan bond index, basically what they've done is they've from many countries they've chosen few countries in terms of their sovereign bonds, and they've made an index so that you have some kind of benchmark for the investors. Now, what they did is they said, okay, fine, India is a country which is a promising nation and we have a lot of opportunities. So we must consider India as an investment, and therefore they have included India and allocated a 10% weightage in the index. So if you collectively see the investors which are following this index, they have an AUM of around $270 billion. Now, $270 billion, if you allocate a 10% wage, it itself means a $27 billion worth of investment has to be done, because these investors are passive investors. They just follow the index. Let's say there are 10 countries with 10% weightage each, and let's say next duration. So the investors will just allocate in those countries those weightages and those bonds. So once the flow will come and set in, and then fund managers, as and when the incremental flows come in, they will keep rebalancing. So $27 billion worth of demand for government bond increases just starting yesterday. So,
Mm-hmm.
but because of this, news was already out, so there were people already coming in from those countries, active investors, and so on and so forth. So, around $10 billion came in. But having said that, these investors, let's say yesterday, they included 1%, and every month end they will keep including 1% towards the March, till the time the 10% weightages is reset. So the investors ideally will buy 1% of the portfolio every month end, wherever the yield is, irrespective of the yield, they have to buy and make sure that the portfolio is in line with the index. So if you look at supply of bonds, considering the supply of bond as X, the demand was already there because there is interest rate cut expected, rates are high, we are at the peak of the cycle. Over and above, you add on one more catalyst of index inclusion and sovereign rating potential upgrade, potential other index inclusions which are in talks, in the pipeline. They may be a story 6 months, 9 months down the line. So there is a huge amount of investors interest. All the investors who have long term liabilities and they are looking for asset, they are not just managing their okay, my interest rate views so and so, I will be in the shorter end. So they're just buying the longest end possible, 30-year, 40-year, 50-year. All the longest assets are being bought, and therefore the curve is flat at this point in time. So this is
Mm-hmm.
just increased the demand for bonds, increased, and these money is not temporary. This is once it comes in, it is going to stay. And incrementally, there may be $1-2 billion kind of volatility. That is always fine. But this $25 billion, $27 billion will come, stay, and as and when this AUM keeps growing, you'll have your automatic 10% share in whatever incremental flow these investors have in their portfolio. And moreover, other indexes will also come in, so you will clearly create much more demand from the offshore, because it typically happens that this guy has included India, this index is doing better because we have relatively higher yielding bonds, which are internationally our rating was not as great, but potentially we have a better credibility in terms of our credibility to service our debt. So that's the debate
Mm-hmm.
going on. And the moment we just get a two-notch upgrade, there is a plethora of opportunities suddenly plunging in to take these yields. So therefore, I said it's a fundamental shift. There is a spread compression, and going forward, you will see a good amount of deceleration happening into the Indian sovereign yields.
Mm-hmm. So what I can understand is basically the demand which is going to come from global
Yeah,
players
from the
selling
global
that investors, that is what is, and it is going to increase in the future. That
increase in the
itself will, that itself will keep the yield lower.
exactly. So demand will
On top of
keep coming in, and if you look at the overall yield they are generating at this point in time is 2%, 3%, somewhere 3.5%. And India is, if see, at the end of the day, what used to happen? We used to give 7-8% kind of coupon, but the currency used to depreciate significantly. So eventually, dollar yield used to be lower. But
mm,
last few years, the dollar returns itself is higher because the currency is not depreciated, and the dollar yields have itself gone up. So dollar guys have not got any returns, while India in dollar terms has delivered much better returns.
mm,
So if dollar doesn't depreciate, like in real terms, they have higher inflation, we have lower inflation. Ideally, rupee should appreciate. But
mm,
at the end of the day, there are other trade and complicated issues because of which the rupee is depreciating. But if you
mm,
observe, the depreciation is much lower than what it could have been. And there
mm,
is a point in time where if your trade deficit also narrows down or becomes surplus theoretically, let's say, current
mm,
account become automatically surplus and BOP will be surplus. So dollar rupee will be having a much larger demand than the supply.
mm,
So actually, the dollar will depreciate against rupee,
mm.
and therefore your returns, whatever you are giving, will be dollar returns, not rupee returns.
Right, 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 right.
So against 3%, those investors are getting 7% or higher, or let's say 6% also is a
Mm,
50% higher jump,
mm,
right?
mm.
So you have to look it from that angle, and it's a complicated equation though. But I'm just explaining in very simple terms. This is how the equation eventually will turn out to be.
Right. No, absolutely. And on top of that, there is a lot of noise happening that RBI may cut rates. But what do
Yeah,
you feel?
that's the another
Maybe,
angle.
yeah.
Yeah.
So
So
can you elaborate that? What do you feel is going to prompt RBI? The reasons for them to go for a rate cut in the future. We never know when, but in the future,
yeah.
in fact.
So as we speak, the in terms of pure fundamentals, if you look at your inflation, the forward-looking inflation has been projected at around 4.5. But the RBI targets at 4%. But it hardly matters if you look at the core inflation, it is close to 3% as we speak. So,
Mm,
from all practical purposes, if they want to deliver a cut, there is no binding as such in terms of delivering a cut. But the risk, which is very clear at this point in time, is we don't know how the monsoon is going to shape up. That is
mm,
one. Though RBI is very clear that monsoon is not in their control, but they would like to watch how it is shaping up and where is the impact coming in, and then they would like to act upon from that angle. But even much more important event which is around the corner is the budget.
mm,
While the opinion is that the government is likely to walk the talk, the fiscal profile is going to be maintained, the revenue expenditures are going to be much lower. The freebies, what I mean to say is freebies, etc., will be much lower than the capital expenditure and so on, which they have been promising and they've shown in the interim budget. So
mm,
more clarity will emerge, and let's get it done in writing instead of a view. So that will decide how the inflation is going to shape up in the future from
mm,
the fiscal point of view. Because if you're fiscally loose, it is inflationary.
mm,
That is much more draconian or much more bad than what a monetary inflation can be. Because monetary inflation comes and you tighten the monetary policy, it goes away. But once you
mm,
create an inflation because of fiscal profile, distributing freebies, excessive in what economy can sustain, any kind of freebies, let's generalize it for the time being, it creates some inflation somewhere, which is
mm,
a sort of permanent. And the government at the end of the day is borrowing. So
mm,
borrowing, printing, and inflationary. So all these things effectively ties hand for the RBI to be loose, even smaller in terms of from the policy angle. And
mm,
over and above this, we have international issues. We don't know what's happening in Fed. The data keeps puzzling here and there. Sometimes suddenly there is a talk that they may have to be higher for longer, not only higher for longer, but there is a possibility of hike as well. We rule out that kind of a possibility at this point in time. But
mm,
the cut debate is on. In all probability, there is a likelihood of a cut in September or December, but that is already pushed. So, but it is likely to come, but it is going to be a slowly building up cycle. But that also RBI would like to see before acting on the domestic side, because our growth is okay. If you look
mm,
at the just overall growth number, we are fine. We are not shrinking as such at this point in time. There is no threat. But if there is
mm,
a rural distress, if there is a problem in the monsoon and so those kind of equations emerge, then they will have to just reevaluate the situation. And we believe first and foremost that what they're going to do, they're just going to infuse liquidity and ensure that things are orderly before touching the rate angle. But eventually, we believe in this cycle, RBI is likely to deliver a 50 basis point rate cut over next 9 months to 12 months, likely to be in the 9 months only. But the possibility of a 12-month can also emerge, but that hardly matters. Once they start, market is going to discount it very, very quickly. Even with that, because as I said, there are other forces which are impacting the interest rate cycle, are going to remain stronger, and which are going to bring down your long-term rates slowly, gradually, irrespective of whatever is happening to the rate cycle.
So what I can understand is that there are the two important things. One is monsoon, and
Yeah.
second thing the budget. I think which is
Yes.
going to be
Yes.
important to determine whether RBI will do a rate cut sooner or sooner or later. Uh,
Correct.
and second thing is that there is an expectation that over a period of maybe 9 months to a year, you're expecting that the rate cuts can happen by about by 50 basis point. In fact,
Correct.
yeah.
Correct.
Now coming to actually, my next question is that and this is the audience is our investors actually, and just for their understanding, suppose there is a 0.5% rate cut, okay, and if someone is invested in a 10-year government security with a carry of about 7%, is the interest of about 7%.
Yeah.
In a year's time, just a calculation, how what kind of
I got
return
I got it.
we get
Got
in
it.
a scenario
Mhm.
if there is a 50 basis point rate cut, in fact.
Yeah.
So what is the calculation which determines
I
that the kind of returns you can expect? Yeah.
I got it. So, see, firstly, I wanted to make them understand is the equation is not linear. There is a possibility that there's a rate cut and the 10-year doesn't move. There is a
Mm,
possibility that there is no rate cut because at this point in time we are at 6.5 repo, and with 6.5 repo we can be at 660 or even 6.5 10-year bond. There is
mm,
a possibility because if the economic environment, uh, investor interest, etc., moves because people are discounting a cut, so that may happen first and then the cut may be delivered, but that's a different thing. Just from a calculation point of view, we assume that the 10-year bond yield is going to go down by 50 basis point. What is going
mm,
to be the impact? This is your question, right? So there's a concept of modified duration, which
mm,
tells you what is the kind of price appreciation. See, carry is going to remain 7% for life till the 10-year, and the bond doesn't generate anything from outside. It is at
mm,
the end of the day front loading your future coupons by
mm,
50 basis point. So 50 basis point typically translate into something more than 3%.
mm,
There's a thumb rule. The duration is somewhere around 6.5. So every
mm.
10 basis point will earn you 65 paisa.
Okay.
So 565, 6 5 is 30. So around 3%, 3.3
Mm,
rupees 20 paisa is you're going to be your capital
mm,
gain on the bond plus the accrual. So if it happens in 1 year, you're going to
mm,
get 7% as a coupon plus
mm,
3 rupees or 3.5 rupees, 3 rupees 20 paisa on the capital gain. So 6
mm,
7 plus 3 is 10, 10.10 and a half percent kind of return for the first year. So if
mm,
that's your objective, that I would like to come trade and go out, then this is the likely return you're going to generate. But my
mm.
recommendation would be stay put because it may happen that you may sell at 6% and eventually end up buying at 5.5 or 5%.
True. True.
So if this is your debt allocation, just remain invested because and go
Mm,
to a longest possible investment because as I said, these changes will tell you what it meant after the event has happened.
mm.
A 7% annuity starting 10-year down the line is going to have a very big meaning, which I can't explain at this point in time.
True.
That
Absolutely.
point in time, it will be probably your retirement salary. You can easily get those coupon and serve because long-term
Mm,
inflation is not going to be as high. It is assuming that it is going to be higher. The supply
right.
demand mix in inflationary goods and services will be such that your inflation will not be as high as it is today.
Mm,
And a 7% annuity will be a gold mine
mm, mm.
for your safety because at the end of the day, as you go towards retirement, you don't want volatility, right? You want
Mm,
safety, and you are getting those 7% on a straight line basis for life. 40
Hmm.
years is what you can create. 10 years down the line, 30 years still will be remaining. So it's a
Hmm.
compounding story. If you look at long-term duration funds, it's a compounding story, which is
Hmm.
sort of assured because it is sovereign.
Hmm. Okay.
So that is
Yes.
what we need to understand.
So this is a very important point that don't look at it tactically. Okay,
Yeah,
tactically will be
it's an
for
asset allocation call. Yes,
yeah,
absolutely,
current
absolutely.
cycle, but
Yeah.
because we are in a structural
Move.
downward
Yeah.
trend, which we can see in
Yes.
the interest rates,
Yes.
maybe the investors will benefit over a longer period of time also, as well as
Exactly.
because of because at 7% carry, the interest rate which you're getting, that is something which will give a positive rate of return or inflation, in fact.
Correct.
We can understand. And in fact, this is a very important point, because I think most of the investment which is happening typically by investors are those smart investors who are investing for the opportunity. In fact, it's more of opportunistic, not for
Opportunity
not
is
looking
done.
at.
Yes. Yeah.
Absolutely,
So you
absolutely.
have to evaluate if you are redeeming what is your opportunity at that point in time. If
Hmm.
your opportunity, let's say you want to buy a house or holiday or something, you want to consume, very welcome move. That's but if you are just doing something, some short term, some long term, or something or the other, and eventually your wealth will be higher, and effectively what will happen, your highest wealth will be deployed at the lowest level, which is what
Hmm.
I want you to avoid.
Hmm. Okay, wonderful. Now, a rapid fire. We'll just play a small rapid fire kind of a thing. Okay, and
Yeah,
I'll just give you two options, and you just need to tell. And it's again, we have a disclaimer in place, so it's something which is your views, okay, which may or
sure.
may not work for the investors. So
Yeah,
that is something which is there. So, my first question is, should you be in a 10-year GSEC or a 30-year GSEC?
30.
30 years. Okay. So 30 years. So that's you should be in the longer end of the
Yeah,
curve. Okay. Second question is uh, GSEC or corporate bond?
GSEC.
GSEC. Okay. Uh, Now the third question is, and which you have actually answered. In fact, this is one question which I had, but I'll again ask you because it's there as a part of this thing. That a 3-year horizon or a 5-year horizon
A
for
5 year
the
horizon would be better.
okay. So you can stay invested for a longer period to get better returns also. So it's not a
Absolutely.
yeah. This is more to do with the tactical part which we just discussed. Actually,
Correct.
in fact.
Correct.
So
So even
wonderful.
if you have a 3 year horizon,
Hmm.
you would be tempted to continue if you have. So better have a 5 year horizon. So if you
Hmm.
want to stick on a liquid segment, you can always get out earlier.
Absolutely. Absolutely. Now, the
So
beauty
we
of most of the funds is that the investors can liquidate if they have a
exactly,
requirement of funds, and they can
absolutely,
liquidate whatever they want. They don't have to liquidate the complete amount. Whatever they require, they
exactly,
can
exactly.
take
Bits
out
and
that
pieces
much
can
of
be
fund.
taken.
Yeah, so that's wonderful actually. Coming to now the other part of it, we have talked a lot about returns, about the opportunities, about why this space looks very interesting. I think now let's come to the risk part of it. Okay. So first thing is, and that is very important. At least at Cedrus, we actually see to it that our investors should understand that piece also. That what is the risk which one carries, and we are talking of specifically right now on the government security part of it. Actually, okay, like what you just mentioned, that's the space which looks more interesting right now. In fact.
Yeah.
So whatever the risk an investor carries, okay, I'll make it easy for you so that for a 1 year, 3-year, and 5-year basis, actually, in fact, okay.
So, typically in the government securities, you only have an interest rate risk. Other risk is not prevalent, but
Uh,
at the same time, the market risk is what creates volatility, and one needs to be aware about it. Let's say something happens because of which the crude oil prices suddenly shoot up. This coalition government falls. These are the two risks which is very imminent, and because of which fiscal will go for a toss. Rating upgrades will be a problem. Your further index inclusion will not happen. And a lot of it's like you have to. Everybody has played game of snake and ladder, right?
hmm,
So at this point in time, we are just getting ladders. But the
hmm,
moment you get a snake, when you are straight going at one or two,
hmm,
whatever, nine number, I guess that the 90 snake that cuts you straight
yeah,
away go to nine.
Yeah, you
So
got in
that's
the
what
bottom
is
line.
happening. Yeah.
Mm,
So these two are very big risk, very low
mm,
probability. But if that happens, then but at the same time, you will have a much bigger impact, disproportionate impact in the equities.
mm,
So that is that way the debt will relatively find your you will find debt as much less impacted. But
mm,
from that angle, if you believe that something can go wrong, then if you are at the shorter end, you will be much more protected. But
mm,
I believe that these are low probability event and would not like to play for it. So
mm.
I'll be at the longer end.
Okay. My last question to you is, something, because you are managing the debt portion of Kotak actually. And which is the fund which you feel is which is something which you would advise an investor to be in, and why?
So, as I explained, that gilt fund or the long duration fund, both are the gilt funds. Depending on your risk appetite, you can choose either which ones. But at
Mm,
the same time, there was a question that whether the corporate bond or the gilt,
mm,
which one you would you prefer? So we have a dynamic fund also, which can oscillate between the corporate bonds. So there is a possibility. Let's say this
mm,
thing plays out effectively very quickly, so
mm,
then we will chase for some kind of yield assets. So we may want to switch to corporate bond. In the gilt fund, I can't do that. So I can do
mm,
that in the dynamic bond fund. So if
mm,
you believe that that is what you are looking for, then you should go in the dynamic. But I believe
mm,
from the long term perspective, gilt fund, if you look in terms of return, has done equally good. So
mm,
the duration will take care of those kind of frictions, and that's why we recommend the yield fund for the long-term investors. But
mm.
someone is wanting the best of the both worlds and hedge or the risk also hedged equally. So the dynamic, or you can go 50-50 in both the funds. That's how I would like to recommend the investors.
Mhm. Wonderful, Abhishek. It was such a pleasure, talking to you. We have got a lot of insights as to why an investor should not ignore the debt markets, which they have.
Yeah.
I can very visibly see
Yes.
the kind of flows which are coming even with us, and we
Uh,
as advisors also. But I think, hopefully, there are more exciting times for debt, as we have seen for equities. In fact.
correct.
With that hope, I think, I'll pass it on to Unnati, who has certain audience questions also,
Sure.
and
Sure.
to the closing comments. Thank you.
I think that was a wonderful discussion, sir. And your valuable inputs has given all of us actually a very differential perspective on how to strategize our investments in debt going forward. Uh, Coming to the audience questions, my first question to you from the audience is that should one consider investing through the ways of a SIP in a gilt fund? And if so, what are the potential benefits for that SIP investment in the gilt fund?
So, see, typically SIPs we recommend in equities, especially because there is volatility and you get benefit of that. And what we have observed is we've seen a secular move in the gilt segment. So it depends. Let's say if you have your lump sum and still you want to go for an SIP, or eventually even if you, let's say, invest lump sum, but your regular income will keep flowing in. So if for your asset allocation call, you will have to dependent on the SIPs. So, assuming that you have a lump sum to be invested, so I will say invest lump sum, no problem.
Mhm,
But from your regular point of view, from your asset allocation, SIPs are welcome. That's
mhm,
you're not going to lose anything or significantly gain either. So that's why I said you can look for lump sum investment. But from an asset allocation call, you must consider for your longest bucket this for your this is your safety net. Let's say there is some dislocation in the equity market. Suddenly you want to shift your assets, you can use this for that. And otherwise also something should go as a long-term annuity, which is going to be the safest and sure short earning bucket from your investment portfolio.
So, Abhishek, I'll just put it a little, because this is something which is very interesting. At the start of my career, I remember, and which you just mentioned when we were just talking offline, that we have seen double-digit, coupon on gilt funds. And I
Correct.
remember, one of the one of the fund managers we used to discuss, and that was mutual fund was in its very early phase, very nascent
Correct.
phase. And he just told, yeah, Nilesh, do one. I'll tell you one thing. You do an SIP in Gilt. In fact, so Gilt was there. It was a corporate product. A lot of people, corporates used to invest in Gilt very actively. And they told, yeah, SIP in Gilt is one of the best options because you don't have that much money to invest in bulk in that phase of time. And it gave wonderful returns then, but that was a scenario where the yields were contracted to where we are today at sub 7%. It used to be in double digit that time, in fact.
Correct.
That's an experience what I thought I would like to share, that we did get good returns, but they were from double digit yields to today what we are seeing sub 7%, in fact.
Correct.
But do you feel, what I think, why this question, why it's relevant is because there is a lot of short-term money which people have some requirements actually. So,
Correct.
people typically go and put money in recurring bank deposits. Okay, they go and this is the money which they may require in 3 years or 2 years, or liquid money which is there. So, does it make sense to put into government securities because it is one of the most volatile debt instruments actually, in the
Okay.
sense that
Yeah.
volatility is higher compared to other instruments actually. So do you feel that among that the gilt fund is a better option if it's for a
Uh,
2 to time horizon?
So from the short-term perspective, while there is a good amount clear opportunity, but at the same time there is a risk also. So
Hmm.
for short-term perspective, we will say you go for short-term funds. Also, there is no harm because curve is flat and absolute shorter end it is inverted also. If you look at your one-year product, they are having 7.5 plus kind of ITMs. So clearly, you are going to short. You are going to achieve that. Should you remain invested with shorter end. So from your short-term perspective, you can choose because the curve is flat. Had it been steeper, I would have recommended gilt fund still. But from
Hmm.
your short-term investment perspective, you can choose bond short-term, PSU banking debt fund, uh,
Hmm.
or even bond fund also because bond fund is not having as high duration as the gilt is having. So you can
Right.
choose bond fund as well. So these three funds are clearly okay for let's say 6 month to 18 month anything which whatever you are looking to invest, and
Hmm.
from your long term guilt is always anyways based there. But a lot of time we get questions in terms of direct investment versus mutual fund. So I would like to just give you a small data point, like when the guild fund was launched in 1998, while the rates were high that time, but it collapsed very quickly. So if
Hmm.
we look at the fund has delivered almost 9% CAGR, while if you would have bought directly you would not have got anything something like that, and eventually your coupons would have got reinvested at different levels, while the fund has been able to deliver much better return. And similarly, if you look at from the 2003-4 scenario when the yield collapsed to 4.5-5%, then also if you compare the fund returns are 1.5-2% higher from that angle as well. So
So,
fund investment is liquid, and fund has done relatively better
hmm.
from just passive investment versus active investment
Hmm.
is what I wanted to highlight
Right.
here.
No, that's a wonderful point actually, because this is something which is happening. That a lot of people are going and investing directly in gilt,
Yeah.
but you cannot keep changing maturities the way a fund manager.
Exactly, exactly. You will keep forget track of coupons. For small lots, you will pay premiums, which will while this selling you will find it difficult. So it is going to be a Herculean task. Mutual fund is much simpler, and it's much cheaper, and you are going to get a much better overall experience in terms of your long term bucket.
Wonderful. Thank you. Thank you, Abhishek. Unnati.
Thank you, sir. I think that was wonderful. In fact, your inputs have given us a lot of insight on how to manage our debt investments. One question which I had from the audience was, uh, what strategies can one adopt, or how can one hedge against the interest rate risk that we foresee?
Hedging in terms of, I'm not sure what exactly. See, I explained reinvestment risk, so you have to be in the actively managed long-term yield funds, so that I, as a fund manager, because we foresee that risk, we are running highest duration. So you are covered for 30, 40 years, and you are very well sorted. Now, probably he's trying to ask a question: if the interest rate should they go on the reverse side, what is going to happen? So from that angle, I just wanted to highlight here. If you remember what happened last year the curve was very steep, rates were high, rising, and that time we were recommending that buy floating rate bonds. So time to time we keep adding these floating rate bonds to our portfolio, which protect you from the rising interest rate scenario. So while we have protected your downside and delivered upside in the last year, this year when the yield started going down, we have delivered the upside as well. While there is a certain level of sacrifice from the total opportunity, let's say the total opportunity was 14-15%, we have given 11-12, but at the same time when things were zero, we gave 4-5-6. So some trade-off is there, but yes, so this is how it happens. When you are invested, you are getting protected on both sides. If you believe it is getting priced in, everything is priced in the current prices, so we would like to reduce the risk and buy counter cyclical assets in the gilt fund. So gilt is actually a sort of an equity fund. We have to buy cyclicals, counter cyclicals, go short, go long. Short in the sense on the segment side. So we keep doing those things, and therefore these returns are superior vis-a-vis a passive investments.
Wonderful, sir. Thank you so much for making the time to grace a knowledge series. It was wonderful to have you. And I would also like to thank Kotak Mutual Fund for arranging this session. And to all our viewers for tuning in and making Knowledge series a success as always. We will return next month again with a new speaker and a new topic. Thank you.
Thank you, Nilesh. Thank you, Unnati. I'm really
Thank you.
glad to be a part of this.
Thank you.
Thank you.
Have a good weekend.
You too.